The dollar is under selling pressure with a big week in focus as we do have the FOMC rate decision and a lot of volatility still to come from the new US President Donald Trump. Guys, Ken Chigbo back with another EA's Market Fundamental update. Let's jump straight into this. So, the US dollar has come under some selling pressure with 2 consecutive weeks now to the downside. The slowdown was inevitable because we've been moving in one direction, and you have to see it as we had all that pumping on anticipation of Donald Trump coming into play in terms of his presidency, his bullish the dollar, his pro-business policies, his tax cuts, all inflationary, which are obviously supportive of dollar upside because we have the FOMC markets are expecting them to keep rates higher for longer. And then, of course, the facts came into play, so we were buying on anticipation and then we sold on the fact. Donald Trump came into play and obviously dollar correction, profits takings coming off the table. But also the fact in the latest weeks, markets were thinking the worst, right? That Trump would sit down and then he's going to start slapping tariffs, bam, 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 as soon as he slapped down. Really and truly, is he going to do that? Not realistically. But there's been a calming of concerns around that and the fact that maybe he isn't going to be so aggressive and he's going to be fair. That's what he said in Davos. So that's helping create some risk appetite in the markets. Remember, dollar's a safe haven, and obviously dollar's it's just an excuse as well for a technical correction because nothing really has changed drastically on a fundamental level, on a macro level by any means. But this week, things will come into play because we do have the FOMC rate decision. Now, if you look at the dollar here, first of all, obviously just fitting what I said with that dollar downside, on a weekly we had that what could have been, and obviously it was validated by, but we had an evening star there appear at the top of the trend, coming into play at that psychological sort of 110-110.50 area, and obviously validated with that bearish, extremely bearish candle last week, as I said, with the reasons that I've noted. If you look here at the dollar, for me, obviously we have FOMC in focus, and I'll come back to the dollar in a moment, but we do have FOMC in focus on Wednesday where we're expecting the FOMC to keep rates unchanged. The thing is whether they're going to be acknowledging that inflation slowed down. We saw it on a month-for-month basis coming down, but on an annualized level, inflation remains sticky. You have to remember the bigger picture. Month-for-month is all volatility, is short-term factors, but then the annualized gives us a true reading of where inflation is trending. Is it trending higher, or are we getting deflation, or prices, or is inflation heading to the downside? Are we coming down? We're not quite nowhere near deflation in the United States, wrong terminology, but is inflation trending to the upside, or is it coming down? So the thing is as well, markets were expecting a hawkish FOMC. As we saw in December, they had a hawkish rate cut. They cut by 25, but they were hawkish because they said the number of rate cuts in 2025 are far and few between, probably just expecting, what markets just expecting 1, maybe 2 at best. And that's because obviously inflation's still sticky. That's because the US economy's still hot, labour market's still good, people still getting jobs being added to the economy, unemployment's low, and wages still high. They're going to be spending, and that's inflationary. And then of course Trump's policies as well, which are inflationary, which Jerome Powell's probably going to acknowledge that at this press conference. For me, I don't think we see any change in terms of their stance. I don't even think they acknowledge inflation as coming down as such. I think they'll still note that it's still away from their target and they need to see it further before they entertain rate cuts. So we'll be keeping an eye on that, and obviously their outlook, which I still see it as remaining neutral hawkish for the time being and not being closer towards a rate cut yet. With that being said, on a technical level, obviously we're at a very key area here for the dollar index, right? You see these previous highs here in November, come down for a bigger retest here. I think there is a potential opportunity that we form a reversal candlestick. Like we saw here, okay, after this big bearish candle, after this evening start, and maybe set up for a potential reversal doji of some sort. Whether it happens here at this mid 107 region, or potentially we have to have a bit more of a pullback just sub 107 into this early 106 range. But ideally, I would like to see something like that. A morning star or reversal doji forming where we could potentially trend to the upside. Now, outside of obviously FOMC, there's obviously a couple of other key events to be aware of. Starting off ahead of FOMC, we're going to have US consumer confidence, which is expected to be bullish at 105.9, up from the previous 104.7. The economy's running hot. Retail sales are still decent, jobs are there, unemployment rate's low. I can't imagine consumers not being confident, okay? When you look at the recent run of consumer confidence, it's been a bit of a hit and miss, but more so remaining healthy, okay? More so remaining healthy. Of course, GDP is key as well. How's the United States growing? We had the previous being revised high to 3.1% after it came in at 2.2 2.8%, but it was revised higher there. Forecast at 2.7%, a slight cooling down from the previous. But I think, the previous here, I still think that we're going to get a healthy number. As I say, the economy is still warm. There's so many components of the economy that are performing well, and I can't see us lagging. Unemployment claims as well. Look at unemployment claims. They're still low. Still less people claiming unemployment benefits, which screams still the labour market's freaking hot. And then we've got the Fed's preferred measurement inflation, which is core PCE, expected to remain at pick up to 0.2% from 0.1%. And then employment cost index expected to be higher at 0.9%. So that's employers' costs. The costs around employment expected to be higher, which again is inflationary. All of this is still screams to me the US economy is outperforming the rest of its peers. It's hot. We've still got risks of inflation creeping up. The FOMC need to remain neutral hawkish, and it'd just be a wake-up call potentially for the markets, which would be like, look, dollar is king. We could potentially get a rebound. As I say, be looking out for a potential reversal candlestick this week, in my opinion, but that is not financial advice. That is just what I would personally like to see. Take it as per you wish. So a lot of volatility incoming for dollar. Now, there's some volatility for euro, because we do have the ECB rate decision where they are largely, pretty much completely priced in by the markets. They're going to be cutting by 25 basis points. Now, remember, when something is priced in, okay, typically, obviously, a rate cut is negative for a respective currency because it discourages foreign investment coming in, because if rates coming down, there's less return for a foreign investor, right? So they'll want to go and seek a higher yield elsewhere. But it's priced in. So we're not in for any nasty surprises unless they go and cut by more, which is unlikely. They're not going to do that. ECB are not exciting like that. So with that being priced in, obviously, the risks are potentially to the upside for euro. However, what is important is the language that they use with that rate cut. Are they downbeat on the economy? We know that growth is slow in Germany and France in key. Obviously, those are two heavyweights in the economy. Obviously, we saw a slight pickup in the PMIs this time around. Public debt levels in Europe still remain high. There's still a massive divergence between them and, for example, the United States. And we're going to take a look at euro dollar in a moment. And then also is the tariffs. Okay, Trump's tariffs. There's still uncertainty there about the tariffs is going to slap on Europe, because that's obviously crippling for growth and for the Eurozone. And, you know, one of the ECB members, I can't remember who exactly, but last year he even noted if these tariffs come into play, there's no reason as to why we can't see euro-dollar potentially down at, fears of euro-dollar down at parity at 1, which obviously I was calling to see at some point this year. Now, if we take a look here, obviously at euro, we're at a big area on the monthly, right? Remember we had this sort of, you could argue as a top area at 112. Ran into heavy supply, evening star, validated by that closure below, selling, broke through key zone here at around 106, just sub 106 down towards sort of 105, about 100 pip range there or thereabouts. And now we're coming up for this big retest, and I expect this to be met with some freaking sellers because it's a massive area, you know, which contained the price in its range for a long time. So obviously on the weekly, you can see structure is still overall to the downside, where we've been printing lower highs, lower lows. And this could still potentially be a lower high, maybe, we could. You know, fitting what I said with the Dixie, where we could see a bit of a reversal candle, reversal doji to indicate the buy momentum has run its course and this buying pressure is exhausted. And maybe we can continue to respect structure, really. But obviously we formed a reversal candlestick there, a morning star, validated with that buying above. Obviously now, very, very key area here, into sort of 105.50, into 106.00. It's not going to be easy to break this down for the bulls, especially if we do get that wake-up call from the markets that, look, the FOMC are remaining neutral hawkish, the ECB are going to be continuing to cut rates, there's a growing divergence there, and it will expand further. The Eurozone is underperforming, ECB could acknowledge that as well in terms of slowdown and growth. Can we see this rejection coming into play and some further selling? So keep your eyes locked on these events. Another central bank decision from Canada. We do have the Bank of Canada rate decision where they're expected to cut rates by 25 basis points. Now, as we've said in previous videos, these guys are one of the most dovish major central banks because we've been cutting rates back to back because we've had a slowdown in Canadian economy in terms of growth. We've had inflation cooling. Obviously, if prices of goods and services coming down, that signals a cooling in the economy and cooling prices. If people aren't spending, then of course prices are going to come down. So that's heading in closer towards the Bank of Canada's target. Well, inflation's there or thereabouts around that. And obviously growth slowing down. We've got the risks of tariffs as well. So this central bank have no reason to be nothing but ultra dovish. All right, so really in terms of the fate of CAD, it lies in the outlook of Bank of Canada in terms of, is this going to be the last cut for a while, or are we going to be seeing another one? And given obviously the slowdown in the economy, slowdown in consumers are not confident in Canada. Consumers are not really spending in Canada. We've seen a slowdown in spending as well. I believe, especially with this, look at GDP as well. I've got GDP on Friday. Look at growth in Canada. It's been hit and miss, more so miss. You know, growth isn't great. There's like limited growth, and we expect it to cut on a month-to-month. We expect it to contract again. So we've got to expect a dovish Bank of Canada, in my opinion. Now, obviously with CAD, we're ranging. We've been ranging for the past few weeks now. But I still stand on the view, we're forming a bullish flag here, this bullish channel, and I'm still looking for that to break out to the upside. But the supply is heavy. We're in a zone, we're in a range, capped to the upside around 144.50, downside capped at around 143, that sort of 150 pip range we're in. I'm still waiting to see this break out, boom, and explode in towards 146.50. If you've been watching these videos, you know week after week after week, I've been screaming this to happen all the way down at, where were we before when we called this 138s, 137s? I still see that as a potential. So keep an eye on the Bank of Canada and Canadian GDP this week. Aussie dollar is also on the watch list this week because we have key inflation data, CPI from Australia. And Australia remains a talking point because RBA are one of those central banks, one of the major central banks that haven't acted yet in terms of rate cuts. You know, all these major central banks, the Bank of Canada, RBNZ New Zealand, the Bank of England, the ECB, the FOMC, all these guys have been cutting, but the RBA have standing pat because inflation's still far away from where they want it, you know, in terms of their target, and the labour market's still relatively tight, and that's one of the reasons why prices remain inflationary. We've still got a low unemployment rate in Australia, so that's why the RBA are budging, but markets have been ramping up their rate cut pricing, expecting a rate cut in February. So this will really shape up those expectations, solidify a rate cut coming in February, because it's still a little bit mixed, or whether that will come later, maybe in May. So inflation, CPI is here really, when you look at it overall, expected to remain sticky. Okay, generally speaking, with the quarter-on-quarter, the year-on-year, but the trimmed CPI expected to cool down 0.6%. Now, with AUD, obviously it remains vulnerable depending on Trump's potential tariffs on China and how aggressive they will be. Because remember, China is Australia's biggest customer, you know, biggest two-way trading partners. Anything that hurts China hurts Australia. So on a weekly basis here with Aussie dollar, obviously it stays to rebound like the rest of the dollar peers have been going over. We've got a heavy supply range here at 63.00, which we're trying to grind down. If we are able to grind that down, obviously the next major zone would be quite quickly in towards sort of 64.00 here. Okay, you can see there, that wick there in August, those lows there also in April. That'll be your next major zone to keep an eye on. Obviously, it could be the case that we get a fake out above this zone, depending on how strong the dollar, if the dollar does bounce back this week or stays a rebound, and we form, you know, even a potential reversal candlestick, like I mentioned, potentially with Euro, like I mentioned with Dixie, where we form reversal candlestick subject to some further downside pressure. But it's all on the fate of obviously Australian CPI, but then more so really as well what happens with the FOMC in terms of their outlook, whether rate cuts are coming sooner rather than later. So apart from that, there are other key events to be aware of. We've got the SNB speaker. Obviously Switzerland is key as well, because these guys have been talking about potential negative rates because of low inflation. We've got the Bank of England, which is key as markets try to suss out when the Bank of England are going to be cutting rates. So we've got Bank of England Governor Bailey speaking. So it's another week full of volatility anyway. Other than that, have an amazing and blessed week, and I'll catch you on the next video.